got the Macro Avengers back for our Q2 roundtable. With us, we've got Tony Greer of TGMacro, usual suspects, Brent Kochuba of Spotgamma, Darius Dale of 42Macro, and a little bit later on, we will have Macro Alf joining us when he swoops in from wherever he is in Italy. But anyway, welcome back, guys. Good to see you all.
Great to see you, man.
What's up, Imran?
I'm a little disappointed I wasn't introduced as Hulk, but we'll take it. We'll take it.
Yeah, don't worry. We all know your alias, mate. Don't worry. Okay, so
you should refer to us only in our Macro Avenger names going forward. That'd be amazing.
Exactly. You would say that. You're Iron Man or something, aren't you?
Yeah.
All right. You definitely got a good one. I think you got one of the better ones. All right. So topic du jour. Obviously, Q1 was a bit of a crazy one. I think we had the macro narrative flipping 2 or 3 or 4 times. I lost count. And some pretty wild moves in that rates market there, blowing a few hedge funds to smithereens. So we'll see what Q2's got in store for us. But I think, the topic on my mind is certainly, are we getting this recession or not? And if so, what do we think the timing looks like, right? Because that's the tough one, right? Even the rates market couple of weeks ago was talking about cuts by June, right? So these things are moving pretty fast and pretty fluid. So why don't we hit that question to start with? What do we think about the oncoming recession that the rate market seems to be flagging? Are we getting it? And if so, what are the data points we need to be keeping an eye on to really get a handle on timing and stuff like that? Darius, you're the obvious one to start with.
I guess so, man. I appreciate everyone for joining, and appreciate everyone for tuning in. So just answering the question on recession, we have a variety of business cycle dating indicators in the U.S. economy that all sort of point to like a modal outcome of Q4 of when the recession is likely to commence. And we've been in that camp, since summer of last year. We've always thought the U.S. economy will remain resilient for an extended period of time. We can see a scenario where you might see a recession get pulled forward in time if we start to see some of the credit contraction issues in the regional banking space deteriorate at a much faster pace. But thus far, we have not seen anything that suggests that really knocks us off that Q4 timing.
Do you think that's when we see the jobs data turn materially sort of weaker as well? Or is that kind of similar sort of timing?
On a headline basis, yeah. I mean, we're already starting to see cracks in the surface with respect to the jobs data, right? If you look at continuing claims as a percent of the total labor force, that's rising pretty sharply off of a very low base. It's like a 50-year low in the time series, but it's rising pretty sharply. We're also seeing, if you look at cyclical unemployment, so this people who are unemployed based on having recently been fired, plus the total number of temporary workers who are completing assignments, that number is actually up pretty substantially on a trailing 3-month basis. And historically, when you start to see increases, on a trailing 3-month basis that are north of 10%, which we currently are, I think it's 12%, it's the most recent number through March. When you start to see that, you're typically right on the precipice or just ahead of a recession. So, there's some cracks developing in the labor market, but we probably won't see it on a headline basis until we get into the second half of the year, likely by the end of Q3.
And I remember seeing construction workers are holding up, right? Because delays with regards to COVID and stuff. So whereas you saw new home sales falling, you normally see construction workers going with it, but that was persisting at a higher level and not really doing what it normally does. And that was because of lags due to COVID and things like that, and projects getting delayed and things like that. So I found that interesting as well.
Yeah, one thing I would say on that, though, which is part of the reason we've had this resilient economy theme since going back to last summer, a lot of the damage that we see early on in a tightening cycle in the economy tends to come out of tends to really impact the goods, the manufacturing sector of the economy, of which housing is and residential construction is one of that. It's such a small share of total GDP, it's small share of non-farm payrolls. It's about 14% of total workers, 18% of total GDP. You really need to see income degradation at the consumer level in order to really start to see a services sector, not necessarily a contraction, because we tend not to contract in the services sector, but to have it slow down enough to a stall speed that allows the contraction we're experiencing in the manufacturing sector to really spill over and cause a broader economic downturn. So I think we're going to get there by Q4, but we're not quite there yet, as evidenced by nominal employee compensation, real disposable personal income, X transfer receipts. These things are all slowing. They're just not at levels that are consistent with the recession yet.
What about you, Tony? What signals are you looking at on that front?
I'm not a biologist, Imran, so I don't really predict recessions type of thing.
Yeah.
But I do, I don't take my eye right now off of the curve, and I'm talking about 2s, 10s. It's buried at minus 65 basis points. I'm trying to assign some probability that the curve is going to start steepening at some point. But while it's buried down here, I know that I should keep expecting economic snowballs to get thrown through the window. And meaning having disappointing data and, whatever economic turbulence you're going to see. I think that lends an upside bias to my treasury view, for the next couple of quarters. Obviously, that's in line with if you're expecting a recession, I think, and, something like that. And I'm watching the dollar. I think the dollar has been is relevant in the fact that it's coming off pretty hard. We're talking about de-globalization of the dollar, et cetera, which, we'll talk about that later. But my view on the economy versus the rates market is don't take your eye off of the rates markets and sort of play the waterfalls that ensue in the stock market accordingly. So I don't want to take up too much time about that because I don't have much to add about recession.
Yeah, I mean, people do say that the curve inverting is a signal, but then it's that re-steep. Like Julian Brigden talks about this quite a lot. Like it's that re-steepening that you get after the inversion that really signals, okay, the recession's happening now, because the re-steepening happens with the front end getting cut really fast, right? And the market started to price that in. Obviously, we haven't quite flipped back into positive on the curve, but yeah, that is usually what you look for.
And it's interesting, and it's because 2s, the short end of the curve is really, really stubborn in backing off because, and it's amazing because the Bloomberg Commodity Index, commodities are offered, there are a lot of them. Everything has gone, up and back. And you would think that there would be a lot of commodity inflation going on if 2s were going to sort of, stubbornly not back off. 2s yields weren't going to back off much, but there is no commodity inflation at the moment, and 2s are stubbornly, near the highs. So we'll see what happens. I got to get them to back off further at some point if the view that we're talking about transpires.
Anything to add on that, Brent?
No, I guess I would have a question for y'all. I mean, earnings right now seems to be, it's early, I guess, in the earnings count. They seem to be kind of mixed. Like Tesla, we're talking today, is getting hit pretty hard. Some of the housing stocks are doing okay. So I guess I look for what's happening there. But I wonder how much some of these traditional signals like the yield curve are being distorted by, number one, the debt ceiling issues. I think that's, there's a lot of Twitter talk about that. And then the second one is just general capital flows coming out of like the banking crisis, that was only about a month ago. And so I wonder how much those kind of traditional recessionary signals could be just distorted by, again, those capital flows, which are not necessarily a signal of, issues in the underlying economy, but more sort of technical, adjustments based on the things I just outlined. So Darius or Tony, Imran, anyone, I'd love to hear kind of your thoughts on that. Because I just, as an ops person, it seems like there's a lot of other things happening as opposed to just like, look, it's as simple a cut and dry as like, we're getting a recession here from now.
I'm going to pass that one to the Hulk.
Yeah. So great question, Brent. And so my thought process on just trying to amalgamate everything that's happening here in 2023. We've had this catchy catchphrase for describing 2023 and what we always thought would be a very difficult year to risk manage, which is there are all these very violent cross currents. On one hand, you have dollar depreciation that, in our opinion, is really a function of the improvement in global growth driven by the recovery in China out of zero COVID, the recovery in European growth, coming off the doomsday prep that they did for the energy crisis that never came. And so that's on the positive side of the ledger. On the negative side of the ledger, you obviously have the U.S. economy kind of on a path to recession. You have a Federal Reserve reaction function that is still very much mired in late cycle employment and inflation dynamics. So that's not, that's contributing some volatility as well. So, markets have been capped, but markets have been pinned kind of in this 38 to 4,200 range. And I don't really see us breaking out of that range until we get into the second half of the year on the precipice of that recession. But going back to the question on the yield curve, I think there's a variety of opinions about what's actually happening, particularly with respect to some of these short-term interest rate curves. You have, for instance, the yield on the 1-month T-bill is 100 plus basis points below the yield on the 3-month bill, and the yield on the reverse repo facility, or the rate that the Fed supplies in the reverse repo facility. So clearly there's a gigantic kink in the curve, and some investors believe that it's really a function of the debt ceiling. Folks in the repo market aren't going to want to take 3- and 6-month bills to the extent that the political situation in the U.S. causes a default. However, there's also a view that would seem to suggest that, hey, this move towards a deep inversion in the T-bill yield curve is actually something more draconian. It actually is a function of, hey, we just lost a couple of banks, so people, active participants in the repo market, are actually pulling back on the types of collateral, the duration of collateral that they're willing to accept, and ultimately we're seeing tighter monetary conditions kind of spread throughout the non-bank lending, the shadow banking sector, that ultimately may come home to roost, in a couple of months or a couple of quarters. I'm not too sure on the timing, but in our opinion, I think it's a little bit more draconian than just debt ceiling dynamics.
I would add, I'm not going to pretend to understand the banking crisis too well, but when you look at the KRE, or you look at, First Republic stock, or even Schwab, Jeffrey, these stocks are all unable to bounce. And Imran and I were talking about this yesterday, that, price is the truth, right? And in this market, everybody likes to buy dips, and those things cannot catch a bounce, which tells me that clearly people smell, something stinks, right? And I don't know if that necessarily means that there's more crises that have to come, but those things are not, there's no value there. At least that's what the market is saying, right? And so I take that as, quite concerning, really, because some of these things are, trading really sharply lower. There was the implicit sort of, or maybe not implicit, but there was some backstopping there, So the point being that there's been some time to digest everything that's happening, and they still can't bounce, right? So,
yeah.
So that to me is a flashing warning sign, and ironically that happens with VIX and volatility now hitting 1-year low. So there's a lot of just strange. It's like a weird risk vortex right now.
Risk vortex, I like that.
On the debt ceiling stuff, Goldman's are now coming out and pretty much saying the same thing Luke Groman has been saying, which is like that it might be the problem comes a bit earlier, right? Because tax receipts are going to be quite light in April. And so whereas we were looking at August time, maybe for the debt ceiling deadline, it might be brought forward to before the end of June. So I just wonder if that's going to, because I'm looking for reasons to why vol might mean revert back higher, because obviously it's been crushed pretty bad. And, I was thinking FOMC might be a worthwhile sort of catalyst, but given that we're 83% now priced for the last hike of the cycle, and the consensus is now we're just going to hold rates there for the end of the year, I'm not sure that FOMC meeting is a massive market mover. So maybe the debt ceiling is the thing that does get things moving again. Otherwise, we could be in a sleepy market still for a good couple of months, right? I don't know. Any thoughts?
Before I hop in, Tony, one thing I would say just in terms of unpinning vol at these low levels, I do think we're on the precipice of a correction. It's likely that we see a pretty substantial increase just based on historical seasonality in the Treasury General account balance on the other side of tax receipts, however light they may come in. And so holding all things constant, we're probably going to see some, relatively modest reduction in liquidity over the next, let's call it 4 to 6 weeks, through mid to late May. I don't think that's, kind of the start of the big bang that we anticipate in the second half of the year, what we've been calling the phase 2 credit cycle downturn. In fact, I'm sure we talked about it in the last Macro Avengers podcast. But, I do believe that, hey, every single iteration we have in terms of this market rotation from 3,800 to 4,200, back to 3,800, back to 4,200, which is, by the way, we've been doing that for almost a year, by the way, pull up the dang chart of the S&P. I think we're running out of those rotations, and this might be the last one or the penultimate one before we get into that big bang process. We think will likely be, sort of by the end of Q3.
Darius, what happened to that net liquidity model? Because you you're sort of the father of that, and of course some of the banks caught on, whatever. And it dominated Twitter for for like a month. It's like net liquidity, and all of a sudden I don't see it anymore. Did that model kind of like, is it the
it broke, just like I said it would.
I didn't want to like speak poorly about a model that you written. I realized
no.
I was like, Darius, your model's stupid. But,
I built many hundreds of models in my day on Wall Street, and that was one of them. It turned out to be one of the more popular ones. Made some other popular ones. But just going back to this net liquidity concept, I think this we kind of got into a fork in the road, much like we've seen in the crypto community with Bitcoin and Ether and all this stuff, with respect to the emergency lending that sort of popped up on the Fed's balance sheet. And there's a school of thought that sort of sees that as, well, Fed balance sheet growth is Fed balance sheet growth, so let's extrapolate that into an improvement in liquidity conditions. And I'm in the other school of thought, which is this is not unencumbered liquidity. It's not akin to QE. These loans need to be paid back. The only reason they're being accessed is because there's a destruction in private sector money elsewhere that the hole needs to be plugged in. So we're of that view. So we've adjusted that model to subtract the emergency lending on the Fed's balance sheet from the sum. But at the end of the day, I don't really think that model is what's going to be driving the bus now, because now we have a whole different set of liquidity things that we need to monitor as investors, which is namely the deflation in private sector money that's occurring in the U.S. economy right now. I mean, if you look at regional banks, they're about 40% total banking assets, and they're now contracting at 4% 3-month annualized rate of change basis in terms of their total assets. And that's obviously being driven by the sharp reduction in deposits we continue to see and are going to continue to see until the Fed really cuts rates and narrows that spread between money market funds and bank rates. So this is just getting going. And I think by the end of the year, we won't be talking about net liquidity. We're going to be talking about private sector money deflation in the absence of public sector money reflation, because again, the Fed's probably going to be sitting on its hands at the early part of the recession.
Oh, that's fascinating.
Tony, you got anything on that?
Not that in particular. I like the vol conversation is interesting to me. To go back to that, if I can, for a minute, Imran, just because it was great for me to see the vol to see the VIX bleed out into the teens, and kind of lie there dead on the pavement right now. We were playing it from the long side during the Silicon Valley Bank blow up, when the S&P, cratered to 3,800 and the VIX went to 30 something. And, that's it fit the legit description of, the opportunities to get into dips and bull markets, right? That dip sort of fit that description exactly. And even though we're in a very different, non-linear, chaotic market, it worked out where buying that dip worked, right? Everybody got bearish again at the bottom, saying, okay, 3,500, here we come. VIX trades into the 30s. And, finally everything, the trauma wears off, and then you see the VIX melt into places like this where, no matter where the S&P lands on the upside, if you weathered the storm to 30 VIX and bought things, this is where you sell things. And so that sort of establishes the top of the range again for me. And I suck at range trading. So, I'm trying to figure out the whole, dynamic together. And that's all I had to add to that. The VIX price action is interesting.
Yeah, it is interesting because we are back at the top of the range. So it is an obvious place to let go of some stuff if you bought. And I think that is likely what we're going to see, or what we're already kind of starting to see. I just think the market isn't rolling over much yet because of all the gamma that's out there. It's pinning the market here for Friday. But, you look at things like HYG, which trades quite closely with S&P. HYG is rolling over because it doesn't have the same amount of long gamma overhang like the S&P does. So I wouldn't be surprised to see the S&P kind of catch down next week once this gamma rolls off to come more in line with what we're seeing elsewhere. Would you agree with that, Brent?
Yeah, we spent about an hour talking about this yesterday, that there's a real synergy between what's happening today in the market and then just a month ago in February. We pinned the same area. We had the same price action at 4150 going into OPEX. And the OPEX pin basically got pulled. We had the same amount of call positions expiring, now that we did in February. And the market has, as Darius mentioned before, been unable to really breach this 4150 to 4200 area. except for a brief moment in August. And so we're going to expire. I think we're going to consolidate next week, and then volatility is also going to shift higher into the Fed. I mean, that in May 3rd Fed. So that's kind of my base case. I think that what's also interesting to me is that, puts, we were also talking about, Imran, that puts were so kind of juicy, arguably, into the bank crisis, right? Like the VIX popped and everybody likes to sell that elevated volatility. I think there's a fair amount of long puts, that had to get sold as well. But there seems to be this very heavy focus on extremely short dated trading. And I think there's not a lot of investing out there. I think it's mostly trading. And so I wonder if the low volatility, the prices moving up rather violently, is just sort of everybody saying, like, we got like a month or so to party before any possible recession, before any possible debt ceiling thing. The bank thing is not an issue right now. So it's like, let's buy this, and it's transient order flow that's going to just disappear in a heartbeat, right? Because I think the long-term investing picture is just very clouded and confusing. And I don't know that, there's not a lot of value out there from what I hear about in small caps. Apple's 7% off all-time highs. The value ETFs are all at, McDonald's is like, I mean, that chart, we were showing that yesterday. That chart is unbelievable. So where do you go for? I don't know where I would park my money right now. Say I feel great about this a year or two out. It just seems like there's some real curveballs there. And if we get down to 3,800, then value maybe comes unlocked again, and you could say it makes some sense. So, I said a mouthful there, and I'm not sure if y'all took away.
Yeah, I think Brent, I love it. I think it's, I agree. This, I have the same thing where this market is really, really difficult to read. There's no sure things. Nothing is linear. There's no follow through on any of the trades that, you piled into that normally would see follow through. And, I still attribute it to a lot of people still being on the sidelines and kind of waiting this out. But I still think a major difference in the nuance of this market now is we have the Fed cleaning up the political mess. And, I don't want to get political, but everything was driven by executive orders on when Biden was elected. That changed the whole face of the energy market, right? That caused the inflation, right? There's a lot of inflation to deal with since this administration, and that's why it's so difficult. I think there's probably a lot of people that are just going to wait this administration out, like a lot of the E&P producers that are buying their own stock back and not investing in the ground. So I think there's just a lot of political quagmire that the Federal Reserve is just stuck cleaning up the mess and fighting the inflation by recapping the economy. So that's a really tricky world to navigate for me, man. That's all I could say.
And we are also getting 5% in T-bills or whatever. Apple launched their 4.5% savings account, right? That apparently sucks $60 billion out of various banks and whatever. So it's like, there's not a bad of a penalty for staying on the side as what there was in like 2021, where you felt like you're missing something major. Like now you're kind of like, I don't know, I'm getting 5%. Maybe I'm all right with that.
Yeah, no, that's
a good point.
Because what's the long run average return of the S&P? 7 or 8? So
I always take issue with that 7 to 8%. It's like, when did you put your money in and when did you take it out?
Yeah. When do you ever have a 7 or 8% return? It's either like up 20 or down 10.
Yeah,
7-8% exactly. That's by lunchtime return, right? I mean,
totally, yeah.
So on Tony's point about inflation, so that's kind of the next topic I wanted to talk about. So it's a good segue. I mean, do we think inflation is going to bottom out soon and rise again, or are we in the more, obviously Darius is talking about going into more of a deflation regime. So what are the thoughts around inflation? Is it more structural? Do we bottom out at 3? Do we get to the target of 2? What have we seen? Have we seen peak CPI, or do we get another go again later next year or something when they pass some stimulus into the elections? Something like we saw back in the last time we had the high inflation in the 70s and 80s. What do we think about that? I'll let Tony go first, seeing he's the commodity man.
Sure, I have an opinion, man. I think inflation that we're dealing with now is politically structural. And I think that as long as there is an attack on supply, as long as there is a drive to, carbon neutral, as long as, there's no letting off the gas in that conversation, energy prices are going to be under pressure on the upside, so it's going to be really, really difficult to sort of battle a deflation. I could see the reasons for deflation, but I just think that as long as we're going to have all of this in place and the whole entire West trying to pivot to, batteries, which is going to, need so much more metal from all around the world, all of that stuff is inflationary. So it's going to come back to bite this scenario in the ass at some point. The Fed is doing everything they can to keep it backing off. And at some point, the commodities are just going to rally like beach balls underwater if we continue on this path towards, global electric battery power. That's my view.
And I mean, Tony, correct me if I'm wrong, but I think sugar hit a 11-year high. I think I read this morning. I think cattle's at, I don't know, all-time high. I mean,
yep. They're flying off the handle all over the place.
Some CPI and inflation reports, but none of that stuff seems to be coming down. Housing prices, so I think rents don't really maybe roll over very easily. It just seems like stuff is going to be slower to mean revert.
That's what I think.
Anecdotally,
that's what I think. It's hard to say. We're talking about predicting this recession, and maybe people's spending habits have changed and stuff. But, it's still $500 to sit in the last row of an NHL playoff game, and you still can't get a reservation at a steakhouse on Tuesday. And, all of this stuff makes me just say, I don't know, there's just an endless supply of capital for these types of, maybe it's just recreation type of thing. But I don't get terminally bearish on the economy because of things like that.
Oh, Darius?
Yeah. Yeah, one thing I would add is you can really only contract in terms of, certainly in the history of the U.S. economy, from a fully employed, full consumption state, right? You don't have recessions from an unemployment rate that's at 10 already. You have it from when it's at 3.5. And so, in terms of our belief system around, timing of this and how that process is likely to play out, we're already seeing a pretty consistent trend of deceleration in, kind of various metrics of wages. Whether you look at nominal employee compensation, that number is at 5.8 on a 3-month annualized basis. You look at real disposable personal income, ex transfer receipts, that number is a little bit over 2 on a 3-month annualized basis. But these numbers used to be like plus 10, 15, 18 months ago. So they're moving towards more normalized levels. The issue with us being able to stay at those normalized levels is we still have to deal with the lagged impact of monetary tightening that is not done. Right, going back to this inflation picture, we've been coaching investors to kind of only look at inflation through the prism of 3-month annualized or 6-month annualized, and mostly 3-month annualized rates of change. And the reason for that is you want to front run the Fed reaction function to changes in inflation. I don't think the Fed reaction function is at all beholden to or anchored on what are likely to be kind of base effect driven disinflation in the year-over-year statistics over the next, call it, few quarters. I think what's more concerning to the Fed, and clearly why, you heard Waller out, you heard John Williams out this week, you heard Powell in the most recent press conference, this is why the Fed is still tightening. We still have median CPI compounding 3-month annualized at nearly 7%, trim mean CPI at 5%, super core CPI at 4.3%. All these numbers kind of feed or lead into core PCE, which, going back to February number, that number was still at 4.8% 3-month annualized. I don't care what the base effects do to the year-over-year time series. We're not going to spend any time at or near 2% if we keep compounding sequentially at these rates of change. And so that to me is kind of what I'm saying now is the number one thing that makes me so bearish in terms of the pending, kind of market crash call that we have and, towards the second half of the second half of the year, which is when the recession actually starts, the Fed reaction function will very much not be tilted towards monetary easing. And this is for a couple of reasons that are very important to call out. One, it's very unlikely that we're going to see inflation break down sustainably and sharply and sustainably enough to give the Fed confidence to ease at the beginning of that process. And that's an issue, obviously, because monetary policy works with long and variable lags. The second reason, I think, is probably just as important, if not more important than the first reason, which is this is a Federal Reserve that's already forecasting a recession. Implicitly through their unemployment rate forecast of 4.5%. We're currently at 3.5%. There's never been a 100 basis point rise in the history of the unemployment rate time series, which goes back to the late 1940s, that didn't coincide with the recession. They know that. I know that. Claudia Sahm, who invented the Sahm rule, used to be a Fed head. She was on the Fed governor. She obviously everyone in that building, in the Eccles building down in DC, understands that. And so when you put those two factors together, the Fed is already forecasting a recession. The inflation is probably not going to be low enough for them to ease anyway. I think we could have a real nasty market situation on our hands that basically forces the Fed out of the pause that they're about to do and into actually supplying the market with rate cuts and QE. And I don't want to be long risk assets in the process of markets kicking and screaming like drunk toddlers, telling the Fed that they got to stop pausing and start easing. I think that's going to be a very dangerous time for markets.
But I mean, if we
sorry, go.
No, just saying, if we take what happened in March as a dress rehearsal, right, and say, so we saw the banking crisis hit, the rates market very quickly said, okay, we are getting cuts, right? We were looking at terminal rates at 575, and now by the end of the year, we're pricing in three, four cuts, whatever it was. And the stock market looked at the rates market and said, oh, well, if we're getting cuts, then let's buy tech. So yeah, we don't want to touch the banks, with a barge pole, but let's buy tech. And so on the index level, the market did actually fine, right? So
I disagree with that. It corrected 10% in like 2 weeks.
But what I mean is you blink and you miss it, right? Because once the rates move had happened, then the tech buying came in basically, right? And the NASDAQ led the way, right? So I just wonder, do we see some, but then since then we've had, like you said, Fed speakers come out and pretty much reiterate, we're going to hold rates. Okay. And then the rates markets has started to massage that probability back that we are more likely to hold rates for longer, at least till the end of this year. So I just wonder, are we going to see something similar again where, the initial rates market reaction will actually mean that you don't see the stock market sell off until there's some moment of reckoning where the Fed says, yeah, we're not doing anything, right? So I don't know.
Bingo. You just described exactly what I see coming down the pike and have seen coming down the pike for quarters now. This has always been our end game. Is there is going to be a moment in time where the market is saying, give me rate cuts and QE, and the Fed says no. And that Fed saying no process, just like it was in 2018, just like it was in every, Fed tightening cycle before it, is the market has to force the Fed off of its high horse. This is not a Jay Powell Fed with the inflation forecast that they have and the unemployment rate forecast that they have that's going to be, proactive about supporting the economy and financial markets. It's going to be very reactive, in our opinion.
Tony?
Darius, I mean, I could easily see that scenario playing out. I think that's well thought out. And what comes to mind is I feel like the trade that I want to put on is the trade I had on last year. That's when you want to re-short tech and buy natural resources.
Yeah.
I would imagine, right? If the Fed is not going to do anything, into an economy that's weakening with sort of, because of stubborn inflation, to me, that's going to be a green light to buy hard assets.
I would not do that personally. I mean, I agree that from a style factor dispersion perspective that works, but I don't know that works in absolute terms because I think people are gonna sell what they can in that type of environment as opposed to being thoughtful about it. I'm more concerned about the broader beta of the market in that scenario.
You'd rather take the tech short. You'd rather take the tech short leg than buy the commodities leg, basically, is what you're saying.
Yeah, that's fair.
Yeah,
that's totally fair. I get that, and it may be something where you have to wait to buy the natural resources leg after it backs off significally. So I'm not saying that it's going to be Teflon or anything.
But on that's tech,
what I would think about.
On that tech being a short story, do you think the whole AI productivity boost, exponential age theory is nonsense, and you don't subscribe to that at all, or is there something there in that certain tech companies are still worth holding because they are the innovators and they are where the growth's going to ultimately be, and they can kind of withstand a recession? Like the mega caps. There's definitely a big dichotomy forming between the way the mega cap techs are performing and the lower quality techs, right? So what do you think about that?
I'm looking at it as, the one thing that I'm sort of, that is like at the top of my, Gibbons list is since that rate reversal, March 8th, that is the reversal of a rate cycle. And that's how it happens. And no matter what, no matter what the Fed does, the market's now going to put pressure on them to keep cutting, and rates are going to go lower. So I think if you kind of believe in that and you caught that right away, the first idea was to buy tech, and it just became, obvious that big tech started performing. So now where we get that retracement in rates and expect them to potentially fall back, it's going to be interesting to see what stays in the lead. But I think it just means that big tech stays in the lead if there's downward pressure on yields.
Mm-hmm.
And can I make one quick interjection here? When we're talking about this sort of nasty market event that we see coming down the pike, again, this is, in our view, something that's going to be concentrated in the second half of this year that may even spill over into the first half of 2024. This is not saying today you need to run out and brace for a market impact, phase 2 credit cycle downturn. It's still April 20th. Happy 420 to all those who celebrate. It's early. I think we have at least another quarter, in our opinion, if not 2 quarters, between now and when this recession pricing in process, Fed sitting on its hands and ignoring that process. All those things are, in my opinion, likely to be, late Q3, Q4, spilling over into 2024 type events. Between now and then, I don't see runaway upside in asset markets because, again, you still have this tightening rolling through the economy, destroying private sector money, and ultimately kind of causing this credit contraction that will kind of limit top side of the market. But again, I don't know if we're going to break that 3,800 to the downside until we get on the doorstep of that process kind of later in the year. So, I just want to be clear about that, just for, to make sure investors understand the time horizons for some of these discussions.
So I think the last debt ceiling debacle was 2011, right? And equities, I think from April, we're down, I'm going to get it probably a little wrong, 15, 20%, right?
19.7.
So, in that situation, and I, for whether it kicks off in June or whatever it may be, though, do you not see it as that being this accelerant? Because I think one of the other themes is that there is this division between fiscal and monetary policy that seemed to make Powell's job even harder. And I wonder if things really start falling apart into election year and, politicians want to spend, right? And that's going to fight that makes Powell's job harder. And if we hit the debt ceiling crisis and equities come down 20%, do you think you can hit another down 20% off of whatever may, come off of that? I mean, that's like a real 2008 kind of scenario, right?
Yeah,
So I guess what I'm saying is there a possibility that market weakness is pulled forward by the debt ceiling, and that sort of causes a different set of reactions later towards the year? Or is the debt ceiling just kind of this thing that's like we're all making? I'm making too big of a deal of or too worried about?
No, I don't. Just my quick thoughts on this. I don't think you're making too big a deal of it at all. I think there's a school of thought out there that seems to be missing the fact that there's a school of thought out there that seems to suggest that if there's any issues with the debt ceiling, Jay Powell is going to use the Fed's balance sheet to sort of shield less Treasury from a default, right? And that may very well be the outcome. However, I think people are kind of skipping a step, right? Like Jay Powell is not going to prevent a big, kind of broad-based kind of tightening of financial conditions unless he sees tightening financial conditions, right? He's not going to be again. The Fed is a reactive government agency. The Treasury, Congress, all these are reactive agencies. They're only going to do things if things get bad enough to respond to. So that's one thing on the debt ceiling. The second thing on the debt ceiling, which I think is by far the bigger issue, so by far the more important aspect of this process, which is the Treasury almost always, at least you go back and look at, the fluctuations in the Treasury general account balance post the increases in the debt ceiling, they're going to have a pretty substantial rise in the TGA post debt ceiling, which obviously sucks liquidity out of the system. Now, Treasury Secretary Yellen could choose to issue a bunch of T-bills and make that process kind of, very, I don't want to say easy, but can make that digestive process a lot less onerous for asset markets and market participants. If, however, she chooses to issue the same kind of composition of T-bills and coupons as they've done in 2022 and in recent years, we're going to have a poop show on our hands, because not only will you be replenishing the TGA, you're going to be doing it at a time where the RRP is probably flat to rising, given this sort of going back to the spread between repo market rates money market rates and bank deposits. So you could see a pretty sharp reduction in liquidity on the other side of the debt ceiling, irrespective of what happens during the negotiating process. And that's what we have our eyes focused on here at 42 Macro.
Oh, this is
I mean, that sounds like a setup for quite a lot of choppiness in the market, right? Because you could get debt ceiling negotiations go to the wire, political theatre, vol pops, market sells off a bit, then you get a resolution to the debt ceiling and we recover, but then your net liquidity dynamics then kick in and you sell off again, basically, right? So it's basically setting up for another choppy market like what we've seen in Q1, probably towards the end of Q2 rather than in the next month or so, I suppose.
Just real quick, I think people are clued into these dynamics though, right? Like you can't really front run like the removal or addition of liquidity, right? Because it's like real dollars being dumped into the market at a specific interval. But what I think people understand what I just said, or at least large players. You know, we talked to obviously many hedge funds, mutual funds across the global Wall Street. These people understand that. Obviously, you turn on finance Twitter and everyone's a repo market liquidity junkie, even though they don't, 5% of them barely understand what's even going on. But, you know, so I think people kind of get the joke on what's going to happen on the other side of the debt ceiling. And so I think if you're going to see a pull forward of this phase 2 credit cycle downturn that we see associated purely as a function of the Fed not responding in time to the recession, if it's going to be pulled forward, it's going to be pulled forward because Janet Yellen is being, I don't know, just sloppy with how she chooses to replenish the TGA post debt ceiling.
Mm-hmm. Anyone else got anything on that?
No.
If not,
teacher.
If not, why don't we wrap up?
By the way, man, because I'm confused as all hell with the vol space here.
Why don't we wrap up with the sort of last topic, which is positioning for Q2 and beyond, right? So so based on what we've said so far, how are you thinking about the performance of different asset classes that we should be leaning into or staying away from? You know, is the fact that the narrative shifts are so rapid so far this year keeping you prefer sort of to be agile and nimble and think of it more like a trading market? I know Tony's answer to that already, but you know that seems to be his default. But yeah, what do we think? What assets are we in? What do we like? What do we not like so much?
I can start with that one. I got a lot of cash right now. I bought some bank preferreds like JP Morgan and Bank of America in the bank crisis, which is one of the few decent things I've done from a long-term perspective for a while. And then I own a good slug of puts in this S&P. So I own some shorter term stuff just because I think there's going to be some volatility mean reversion. And then I own some SEP in December on the idea that I do think that there are a lot of unknowns right now that people maybe can't be planning for, a la why won't regional banks bounce? And I don't pretend to understand a lot of what Darius said. I'm in the 5% of the companies that don't get it, but I understand enough to know that things are a little squirrely. And I think that with VIX at 16, that volatility is the volatility carry is easy to offset. So I'm happy to sort of, pay that decay bill and find some ways to offset that in the short term. So I think the market's going to come down here. I just think that sometimes you just buy puts because they just seem to be cheap, and implied volatility right now is pricing 1% daily moves, which is the lowest that we've had in well over a year. And I think there's plenty of catalysts to make the market move quite a bit in either direction, really, over the next several months. So that's kind of how I'm positioned.
I got a question. The same question I was going to ask you earlier, which is I'm glad we went through this exercise first. What do you think about this sort of concept of you guys have done a tremendous amount of thought leadership on zero DT and the influence that has in the marketplace. What are your thoughts on kind of the clearly a large chunk of institutional money management has flooded into using these instruments as a way to hedge their assets. When you when you buy kind of cheap puts out in September, out in December, clearly, that's not done with the expectation that on September 29th, they're all going to want zero DT puts on September 30th or on December 30th. They're going to want them on December 31st. So do you see like a return to kind of like term hedging and like a natural bid for skew coming back in the market? And if so, like what's the catalyst for that?
I'll take a stab at that first, and then I'm sure Imran's got some things to say too. I think there was zero DT worked really well for like, I guess what I call like idiosyncratic risk. Like, let me hedge the CPI number coming out tomorrow. Let me hedge what the FOMC is going to be, blah, blah, And the growth of 0DT just exploded in Q4, and then it stabilized such that it really hasn't grown since really late Q4, which tells me that whatever strategies people are deploying using 0DT have basically like maxed out, right? So there's not necessarily these new use cases, but more to your point, when the lowest levels of 0DT since Q4 were in early to mid March. So the minute that the bank crisis came up, and there wasn't like this necessarily idiosyncratic risk that you could like, I couldn't say, hey, the data point drops at noon on Tuesday, so 0DT suddenly didn't help you out there, right? VIX went to 25, 30, and suddenly it was the idea of like, we got to own longer dated options in here, and the percentage of flow that was 0DT subsided rather sharply. And so I think, 0DT is this like musical chairs phenomenon in a way where we're all partying today because I don't have to worry necessarily about what tomorrow's going to bring. But the minute there is a little bit of like real risk to the market, then I think that there's an initial 0DT washout as a lot of like, retail and the like who are short these things consistently get blown out by, the Vega trade, I guess I call it. So Imran, feel free to.
Yeah, I think you've hit the nail on the head. I think that when you don't know the timing, when you don't know what time the data point is coming that is going to move the market, and the issue becomes more systemic, and it's like, oh shit, we're in the middle of a banking crisis and we don't know when we're going to get a new headline about a commercial real estate problem or a banking problem, or these are the things that make you gravitate towards more longer data protection, right? Now, the only flip side about whether people are going to pile in and buy skew is are people invested enough, right? So the biggest bid we've seen really to skew this year was when everyone piled into the market, right? So in January, the market started to go up and everyone got sucked back into owning the market, and skew went up with it because they had something to protect. The market's gone back to the top of the range at 4,200. They're all lightening up their exposure again, the discretionary guys. They don't need puts. That's why puts are offered only, right? So it's a question of being invested, then seeing something break and shitting yourself, and then needing to buy puts, basically, right? That's what really drives vol spikes. And that only happens when you get a shock, when you get an unknown event that suddenly has brought fear back to markets that are long and aren't already prepared for the market going lower, like they pretty much were the whole of last year. The reason why vol never caught a bid last year is because we had so much time to get used to the idea, and everyone expected it to just bleed down, so they just didn't have too much exposure, right? So I think that's going to really, I don't know how it's going to happen, but you kind of need people to get back into the market enough to then drive a vol spike later at some point when something actually hits the tape that spooks people. Yeah.
What do you think about the idea though? Like if credit becomes an issue though, because that could be the incremental driver of equity put protection, right? If suddenly credit risks do start to pop their heads up. We never had that last year. Right?
But I'll give you an example, right? 2007, 2008, I was trading at that time, and the credit market blew up in 2007, right? The equity market didn't give a shit till like late 2008, right? So you can have a credit problem, but equities, for whatever reason, can continue to rally. We've seen it happen before. It can happen again. So whilst I agree with you, the things that really will drive a bigger problem systemically in markets are credit problems. Now that the Fed is so closely watching credit markets, and after what we saw in 2020, the speed at which they backstopped the credit market, and we still had a 35% drop, to be fair, right? Like to spook them. But I just think all the reactions are happening faster and faster now. So if they start to really see a problem in the credit market, I think they're going to be pretty quick to react to that, right? So again, I'm not entirely sure that's going to drive a massive vol spike again. It has to be something that comes out of the blue. And I think the problem with, especially us lot, we're all looking for the next thing that's going to make the market puke. We're all trying to second guess it, right? We're not all like bullish and thinking, okay, let's play the next 20% rally. None of us are. Until we're trying to play that 20% rally, then I struggle to see a meaningful vol spike, to be honest. Anyone got anything else?
No, it's great points.
No, great, yeah, very good.
All right, what have I got here to wrap up? What about you, Tony? So positioning wise, obviously, we haven't heard you on the positioning side. What are you thinking? Obviously, looking to sell tech, I guess, at some point.
Yeah, I mean, in terms of market positioning,
well, more like what you think the right positioning is for the next quarter or two.
Yeah, okay. I mean, I think the things that I'm trying to play is, I am a believer in that that rate move in March being the reversal in the rate cycle. I'm going to be expecting yields to go lower. And so in that case, I can, try to play tech from the long side. I've been playing home builders from the long side. They just came out with great news in the last couple of days. So I think that there are tactical trades that you can clip. And I'm like even more short term than usual, lately in terms of, renting things, for shorter periods of time, because everything is, like I said, nonlinear and chaotic. And with the curve at minus 65 basis points, you can't be shocked to wake up and see some, economic disaster all over the tape. And that's obviously going to shake up, your views and positioning. So I'm kind of prepared to see things like that, which is why, I chuckled out loud when Brent said, what are we being for the next quarter? And he was like, cash, and I've been the same way, because it's like, in this environment, it's the best to be sitting here to wake up in the morning and turn your screens on with dry powder, and not be bent over a barrel, because something just collapsed in your face that you bought last night or whatever. So I've had more opportunities where I'm flatter more often than not, and trying to play tactically, the trades that the market's giving me, and I'm doing that saying, I'm not just playing these trades because, rates are backing off. I'm playing these trades because since March 8th, the leaderboard for this year dramatically changed in the stock market, and everything tech rose to the top by order of market cap. And so that's what the performance is lending to, right? And that's where home builders have been performing. And so kind of that's where I'm shifting my money for the next kind of quarter or so for the year. And I'm doing it tactically, like I said, where I'm kind of in and out and just trying to make those plays from that direction where I can. And I don't have a lot of stuff to short because I'm not like terminally bearish, and I'm not a great range trader. So I kind of play from long to flat in these scenarios, and sitting on a lot of cash along the way.
And so you're the likes of XLE and XME that you've historically been quite favorable on. You're flat those right now and waiting for opportunities to buy later in the quarter.
I am flat those. Just to share on my view matrix currently, I'm long bonds, I'm long Qs, I'm long semis, and I bought those. Those are, a couple of percent in the money, and I'm managing that. And I'm still long refiners and gold, right? I'm long refiners because I think they're the tip of the energy spear. One side of either gasoline or diesel demand has been super strong globally. And so the refiner spreads are super wide right now, and the crack spreads, and they're still, kind of panning out into earnings. Those are among the few stocks that I could find that have just remained in a bull market through all this volatility and not broken trend. And that's why I stay with those.
You haven't seen a chart of McDonald's
or Hershey. Have you seen that one? There's a couple of consumer charts out there that literally blow your mind, and it, I don't know I think that's a recession trade. No, Brent?
If you see my Uber Eats orders at midnight, you would understand why.
I get more and more tempted. That's the one place you could walk out of and spend $5 and walk out, at least somewhat full.
Totally. Yeah.
There was a Twitter receipt picture going around like a month ago of a Big Mac meal that was $16 because of taxes and whatever it is in Connecticut. So it was like the guy, this guy rolls, this whole big thing about. I thought this was supposed to
be fine dining, mate. Fine dining.
That's basically what it is.
Hey man.
Yeah, man.
All right, so
just still making good over there.
Just to close out, then. So obviously we've seen the VIX trade on 16 handle. Do we think we're going to go into a low vol regime for a sustainable period of time, or is this a good opportunity to buy vol? Because I've been covering shorts, but I've been purposely sitting on my hands and covering shorts on vol, that is, because I did call the cyclical sell-off in vol into Easter. But now I'm covering shorts, but I'm kind of sitting on my hands trying not to get too long, because I'm a bit concerned that low vol doesn't necessarily equal cheap vol.
Mm-hmm.
And I kind of want to have a reason to buy vol rather than just buy it because it's low, basically, right? Because I've made that mistake many times in my career, that I've once bitten, or let's say 10 times bitten, 11th time, maybe a bit shy, right? What are our thoughts on that?
I got a quick thought on that. So as I mentioned earlier, I do believe the markets are on the precipice of a correction. Maybe we'll see 3,800 again in the next, call it 6 weeks on the S&P. And that, in my opinion, is driven largely by this inflection in both domestic and global liquidity. We talked about the TGA tend to rise, having seasonal bounces post-tax day, meaningful seasonal bounces post-tax day. So that's the domestic side of the equation. On the international side of the equation, one thing that has been very positive for our transitory Goldilocks view throughout the year to date has been this massive surge in global liquidity. Whether you amalgamate global central bank liquidity, that peaked at 1.4 trillion on a trailing 3-month basis in January. You look at, private sector liquidity. If you look at M1, that peaked at, just over 2.2 trillion, plus 2.2 trillion on a trailing 3-month basis through January. So that was clearly part of the move in risk assets off the October lows, which I missed. Most everybody missed, if we're all being honest. But I think on a go-forward basis, and why we do see some volatility ahead over the near term, you've actually seen those numbers reverse pretty substantially. If you look at the most recent month of data, we're down 332 billion in terms of the global central bank balance sheet. Obviously there's still a lot of money working its way through the system, but if you look at the system that the money is working its way through, if you look at narrow money supply, that's down 713 billion on a trailing 3-month basis. So we had this massive impulse of global liquidity off the October lows. The impulse peaked in January, and now the impulse is negative. Now, so, obviously it takes money, time to slosh around the financial system. This stuff is literally not rocket science. It's more of a soft science. But the reality is it's going to get harder for asset prices to sustain these levels without some form of money reflation, either via the international public sector, or the domestic public sector, or either of those private sectors. And right now it's kind of negative in all directions. I don't know. Again, I keep saying, like, this is not the beginning of the phase 2 credit cycle downturn, because I think it's going to take more than just a negative inflection in global liquidity dynamics to get the market to break out of this 4,200 to 3,800 range. I think what breaks us out of that range is a recession in the world's largest economy, and the Fed saying, go F yourselves at the beginning of that process.
Right.
That's been our view, and that's been our view all year.
What about the others? What about Tony? What do you think?
Yeah, I'm not. I tell you, Imran, I'm not an options ranger or specialist like you guys, but the scenario that's very tempting to me, who uses spikes in the VIX into the 30s and stuff to get long stocks. With this bleed down here, I really appreciate your comment that cheap vol doesn't necessarily mean valuable vol, because as we know, the VIX can necessarily find a range at 12-15 for several months and sit there. But to me, this is one of the more tempting trades to start clocking in sort of piecing together, long volatility strategy, because I kind of agree with Darius in a way that there's some kind of a downside test coming again this year. And, you kind of say yourself, like, you don't know that there's not going to be someone that taps you on the shoulder and says, okay, Imran, this is the time to buy vol. But if, you watch the performance of it versus how stocks are trading, and, you start to see stocks back into moving averages with the view that they're going to back off further, vol's dirt cheap down here, isn't it?
Mm-hmm. Mm-hmm.
It's just a question of timing it right.
Yeah.
Well, Brent, we know Brent's longer truckload of puts, so I kind of know his answer.
Truckload is certainly not the right way to put it, but I also think I think we could come out of the Fed where it's a nothing done on the Fed, and then we just grind for a month or two until debt ceiling stuff starts. So there you go, VIX 14. To exactly your point, cheap doesn't low doesn't mean cheap in terms of the volatility. So like I said before, I'm prepared for that scenario because I think it's pretty easy to carry. I think the vol is pretty easy to carry. And to me also, I focus on such short dated trading now because I think the signals are so clean, particularly when nothing else is going in the market. The zero DT flow moves stuff around in really predictive ways. And so for me, that's not interesting for macro people, but for me, it's easier to kind of focus on that. And then, take some swings at some other things when they get interesting in terms of longer term holdings. But nothing stands out as obvious to me at this point.
The two things I'd say on the long vol side that I've been saying to subscribers lately is that in a low vol environment, especially like S&P vol, for example, on the upside is at 12, right? It's pretty damn cheap. Very, very seductive when it's at 12, right? You just want to close your eyes and buy it. The reason it's at 12 is because every man and their dog is long it because they keep getting sold that upside, right? So often it makes more sense to own the stuff that's actually holding up much better, like the NASDAQ. So NASDAQ vol on the upside is at 17, whereas S&P is at 12. So you might say, oh, well, I want to own the one that's at 12. The reality is if we rally to like 4,300 on the S&P, that's probably going to be at 10 vol, right? That S&P vol. Whereas the NASDAQ vol might actually hold its value, if not go higher, because no one owns it, right? So you often want to own the more expensive vols in the low vol regime because they'll stay expensive, right? Which is not something everyone really is aware of, but that tends to be the right way to be because the fact they're expensive is telling you that no one's got them basically, and no one's being supplied them on a regular basis, like on the S&P and the Euro stocks in Europe, for example. Right? And then the other long vol trade that I've been looking at is just HYG, because I'm of the belief, and I don't know if I'm right, but that even in an equity market squeeze, HYG is not participating on the upside, right? We've seen it a couple of times now, probably since last summer, where stocks have squeezed pretty hard, but the likes of HYG, whilst they rally, it's got no real sting to it, the rally, basically, right? So, and vols in HYG are 8%, right? Obviously, it doesn't move that much, which is why they're at 8%. But in a shit show, if you were to get a shit show scenario, then things like HYG can come alive on the downside because credit spreads have got a hell of a long way to go compared to where they typically would be in the face of, you know, what the small business surveys look like in terms of credit availability. Obviously, typical recessions, we get big spikes in credit spreads as well. So I just think owning HYG downside is producing a very good risk reward for people who want to park something in the book that could be explosive in a downturn, basically. So those are two things I'm looking at.
Yeah, the high yield credit spreads are around 450 basis points in terms of OAS.
Yeah.
At the shallowest recession in U.S. history, which was the 2001 recession, they got up to 1,036 basis points.
Yeah.
Shallowest recession in the history of the U.S. economy.
Yeah, it's mad, isn't it?
Yeah, we're nowhere near pricing in a recession.
Well, on that rosy note, I think we'll wrap it up. Obviously, Macro Alpha unfortunately couldn't make it today, but you guys have been amazing as always. I want to thank you guys for coming to the roundtable. I always value your opinions, and I think we have a good balance here of different styles and views and stuff. So hopefully, the audience will benefit from that. But yeah, thanks a lot, guys, and I guess I'll catch you on the next quarter.
Thanks a lot.
Imran, thanks for having us and great job getting this together. This is really valuable for me just from a thought process of going through structurally what to think. And I think it's really, really awesome. So thank you very much.
Agreed,
Iron Man, it's always a pleasure.
You're the best.
Take care.
Until next time, man.
Appreciate you guys.
Next time. See ya.